Something very unusual just happened, and it didn't come with flashing lights or an emergency press conference. It came quietly, wrapped in bureaucratic language, the kind of update most people scroll past without a second thought. But sometimes the most important signals don't shout. They whisper. And this one was loud to anyone who knows how to listen. After decades of insisting that silver pricing is a smooth, well-managed process, governed by screens, servers, and sophisticated financial engineering, the system just hesitated. For half a century, we were told that the real silver market lived inside computers in New York. Futures contracts, leverage, algorithms firing at microsecond speed. That was price discovery. Physical metal? Almost an afterthought. Always plentiful. Always available. Nothing to worry about. That narrative just cracked. On Wednesday, January 14th, 2026, the United States Mint, the actual sovereign manufacturer of America, OS coinage, announced that it has suspended all sales of silver numismatic products. On paper, it looks routine. A temporary pause, pricing adjustments. Please check back later. The kind of thing you'd expect from a cable company, not the federal government. But read between the lines, and it's something else entirely. This isn't a website glitch or a customer service hiccup. This is a manufacturing halt, tied directly to price volatility. The Mint is effectively saying, we cannot keep up. Not with demand, not with logistics, with price. Let that sink in for a moment. The United States Mint is not a speculative trader. It's not trying to front-run the market or scalp a spread. It's a production arm of the Treasury with privileged access, long-standing supplier relationships, and institutional insulation from day-to-day market noise. If that entity cannot confidently price a 1-ounce silver coin in real time, it means the market is moving faster than the machinery of government can process. The screen price, hovering near $89.67 at the time, isn't just rising, it's outrunning the system. And here's where things get uncomfortable. When a business stops selling a product during a rapid price increase, it's usually not because demand vanished. It's because replacement risk just exploded. Sell an ounce today and you may not be able to replace it tomorrow without taking a loss. Or worse, without being able to source it at all. If the Mint sells you a silver eagle for $100 today and the price gaps to $110 tomorrow, they don't just lose $10, they lose the ounce. And if that ounce cannot be reacquired, because refiners are tapped out or wholesale supply has tightened, then they have effectively traded a strategic asset for depreciating currency. At some point, even bureaucrats recognize a bad trade. So the rational response is to stop selling. That's what makes this moment different. This isn't about margins, it's about preservation. The Mint is choosing metal over money, milk over cash. And history tells us exactly what that signals. Imagine walking into a grocery store. The shelves are full. Milk, bread, eggs, all right there. But when you get to the register, the clerk shakes his head and says, "Sorry, prices are moving too fast. We're suspending sales until further notice. The shelves aren't empty, but the currency has failed its test as a medium of exchange. The store would rather hold inventory than accept your dollars." That's the signal. And it just came from the US government. Now, the ripple effects don't stop at the Mint's doors. Private dealers don't operate in isolation. Companies like APMEX, JM Bullion, SD Bullion, they all take cues from the Mint, whether they admit it or not. The Silver Eagle isn't just another product. It's the most recognized silver coin on the planet, and its supply starts at the Mint. And when that source shuts off, even temporarily, the entire dealer network recalibrates. Inventory becomes something to defend, not move. Premiums rise, rationing starts. Limit 2 per customer quietly replaces in stock, and we're already seeing it. Eagle premiums have detached from spot in a way that makes the screen price almost academic. The so-called $89 silver doesn't exist where real transactions are happening. The street price is telling a different story. Meanwhile, the market itself isn't pausing to wait for bureaucratic approval. While the Mint froze, silver kept climbing. Another $4.50 on the day, a move north of 5%, knocking on $90 like it owns the place. The attempted pressure tactics we talked about earlier, margin hikes, volatility scares, didn't cool things off. They emboldened the bulls. The market smells blood. And it noticed something important. Even the government is scrambling. This is where psychology takes over. $90 is a number people talk about. $100 is a number people remember. And the Mint's suspension didn't slow that trajectory. It accelerates it. By pulling thousands of ounces off the retail market, they didn't eliminate demand. They concentrated it. Anyone who wanted to buy yesterday wants to buy more today because now they've been told they can't. That demand doesn't disappear. It spills into bars, into rounds, into anything that isn't nailed down. The Mint may have unintentionally launched the most effective silver marketing campaign in history by saying no. When sales resume, and they will, don't expect relief. Expect repricing. This pause isn't about waiting for prices to come down. It's about recalibrating for a new regime, one where silver doesn't live in the double digits anymore. That's why this moment matters. Before this, we were in a squeeze. After this, we're flirting with something more serious. When the entity that prints the currency hesitates to exchange it for metal, you're no longer debating charts. You're debating trust. And while all eyes were on the mint, something far more consequential was happening behind the scenes. While retail buyers were being told to wait, a single massive player walked into the wholesale market and did not wait at all. They went straight to the vault. According to the latest CME depository data, over 1.3 million ounces of silver were physically withdrawn from the JP Morgan vault in a single day. Not reclassified, not shuffled between columns, withdrawn, loaded, gone. JP Morgan isn't just another participant in this market, it's the fortress. For years, its vaults were considered the ultimate backstop. The unspoken assumption was that no matter what happened, JP Morgan had the metal. Yesterday, that assumption took a hit. Moving 40 metric tons of silver in one day isn't a retail decision. It's not a coin shop restocking. It requires capital, coordination, and logistics at the highest level. This is sovereign wealth fund territory, central bank territory, industrial titan territory, and it wasn't isolated. Brinks lost over 600,000 ounces. CNT shed 200,000. Loomis gave up another 250,000. In total, nearly 1.8 million ounces exited the COMEX ecosystem in 24 hours. That's not noise. That's a bank run. Just not the kind most people recognize. No lines, no panic. Just armored trucks and spreadsheets turning into empty space. The eligible category, the metal that can become deliverable, is being drained. And that matters because paper pricing only works as long as physical backing is assumed. When the metal leaves, the assumption breaks. So here we are. The government has paused sales, dealers are rationing, vaults are bleeding, and the price is moving vertically. At some point, you have to choose which signal you believe, the carefully worded notice or the disappearing inventory, the official story or the empty shelf, because when milk stops being for sale, it's not about milk anymore. If you zoom out from the headlines and ignore the noise for a moment, the motivation behind all of this becomes painfully clear. This isn't about speculation or short-term profit. This is about counterparty risk, plain and simple. Whoever pulled 1.3 million ounces of silver out of the JP Morgan vault wasn't guessing. They weren't panicking. They were acting on information and experience. They understand something most screen watchers don't. The price flashing on your terminal, roughly $89 at the time, is a reference point, not a truth. They know inventories are thinning. They know vault accounting relies on trust. And trust erodes quickly when volatility shows up uninvited. And most importantly, they know that metal left inside the system is not fully under their control. It can be leased. It can be pledged. It can be rehypothecated to keep short positions alive another day. So they did the only rational thing. They took possession. That old rule still applies, no matter how modern the market pretends to be. If you don't hold it, you don't own it. This wasn't an emotional move, it was defensive positioning by someone who understands how fast paper claims can multiply when physical supply cannot. But there's another layer here that makes this event even more significant for price, and it requires looking inside the vault, not just at the headline number. In the COMEX system, silver is divided into two buckets. Registered silver is available for delivery against futures contracts. Eligible silver, on the other hand, belongs to private owners who are simply storing it in approved vaults. It's paid for, it's not for sale, and it's usually very stable. Most squeezes show up first in registered inventories. That's normal. And yes, registered silver did drop by more than 500,000 ounces, but that's not the real story. The real story is where most of the JP Morgan withdrawal came from, eligible silver. That matters because eligible metal is supposed to be sticky. It belongs to long-term holders who aren't trading headlines. They pay storage fees because they trust the system to safeguard their wealth. When that category starts leaving in million-ounce chunks, it's not a trade. It's a vote of no confidence. This is old money deciding the exchange is no longer a safe place to park real assets. It's institutional capital quietly saying, we're done trusting the plumbing. And once that trust breaks, it's very hard to rebuild. So where's all this metal going? We don't need a shipping manifest to make an educated guess. The global price map tells us everything we need to know. In New York, silver is quoted around $89. In China, physical silver is trading between $98 and $100. That's not a typo, that's an $11 gap. In commodity markets, an $11 spread isn't a pricing discrepancy, it's an invitation. If you go holding silver in the West and you can sell it in the East for more than 10% extra, you don't hesitate. You ship it. You drain the low-priced market to supply the high-priced one. That's not ideology, that's logistics. The silver leaving JP Morgan yesterday didn't vanish. It didn't dissolve into theory. Odds are it's already airborne, crossing the Pacific toward a market that pays what the metal is actually worth. This flow sets a hard mathematical limit on how long suppression can last, Banks can write unlimited paper contracts, but they cannot conjure new ounces out of thin air. Every day that arbitrage window stays open, more metal exits the system. At the current pace, the available inventory becomes dangerously thin very quickly. Weeks, not years. And this brings us right back to the US mint suspension. The mint doesn't operate in a vacuum. It buys silver blanks from private suppliers who source metal from the same wholesale ecosystem. If that ecosystem is being drained by large, price-insensitive buyers, the retail channel starves first. By the time the river reaches the coin shop, it's already dry. This is a classic crowding out effect. The whales eat first. The minnows are left staring at an empty menu. Retail buyers trying to get a single silver eagle aren't competing with other hobbyists anymore. They're competing with sovereign scale demand, and that never ends well for availability. What makes this setup so volatile is that price is rising on paper while physical backing is shrinking. We're trading claims on metal that is actively leaving the building. The JP Morgan withdrawal is the smoking gun. It tells us exactly what smart money thinks about current prices. If $89 were expensive, if this were a bubble, those holders would be selling into strength. They'd be increasing vault inventories, not reducing them. They would be monetizing their gains. Instead, they're doing the opposite. They're taking bars and walking away at all-time highs. That tells you everything you need to know about their expectations. They don't think $89 is expensive. They don't even think $100 is expensive. They're positioning for a repricing event that makes today's move look trivial in hindsight. So now we're left with one remaining variable, price. How high does silver need to go to stop the drain? How high does it need to go before these entities decide it's better to leave metal in a vault than pull it out and ship it halfway around the world? The answer is uncomfortable but obvious. It has to rise above Shanghai. It has to rise above the street premium. Until that happens, the incentive to drain the West remains intact. That brings us to the reality check that bankers in London and New York are quietly losing sleep over. The number on your screen says 89 or 67. That's what the algorithms trade. That's what the media reports. That's what risk models are calibrated to. But reality is no longer cooperating. Physical markets in China are trading silver between $98 and $100 per ounce. Two prices now exist for the same metal. One is paper-based and Western. The other is physical and Eastern. That $11 gap is the definition of a broken market. From a trader's perspective, this is a near risk-free operation. Buy silver in New York, take delivery, move it to Shanghai, sell it at a double-digit premium. Repeat until inventory is gone. This isn't theory. This is why vaults are bleeding and why the mint suddenly can't find metal. The metal is flowing uphill toward the highest bidder. And right now, the highest bidder is China. This represents a structural shift that's easy to underestimate. For decades, price discovery lived in New York and London. The West set the price. The East accepted it. That relationship has inverted. Shanghai is now determining value based on physical supply, industrial demand, and strategic necessity. New York is reacting, dragged upward by arbitrage, whether it likes it or not. China isn't paying $100 because it enjoys paying more. It's paying $100 because it understands silver is not optional. Without it, solar panels don't get built, batteries don't get made, electronics don't function. This isn't speculation, it's stockpiling. They're not trading silver, they're securing atoms. This also explains the apparent panic at the US Mint. The Mint likely contacted suppliers expecting to buy blanks at the quoted spot price. Those suppliers operate in the same global market, and the response was probably short and polite. Why sell at $89 when Shanghai is paying $100? The Mint wasn't experiencing a technical problem, it was being outbid. The sovereign issuer of the world S reserve currency couldn't T-source silver at its own reference price. So rather than admit the number was wrong, it closed the window. That's what early stage currency stress looks like. Not wheelbarrows of cash, not hyperinflation headlines, just quiet suspensions, missing inventory, and producers choosing goods over dollars. We're watching the moment where paper pricing collides with physical reality. The mint is closed, the vaults are open, and the metal is moving. Step back for a moment and look at what's actually forming here. We're watching the world split into two very different realities. On one side, there's the paper market, still pretending everything is normal, still printing prices that no longer clear real supply. On the other side, there's the physical market, quietly but decisively repricing assets based on scarcity, logistics, and survival. That divide is no longer theoretical. It's visible, measurable, and accelerating. With Shanghai printing physical trades near $100 an ounce, the psychological ceiling in New York has effectively vanished. Traders on the COMEX know it. They may not say it on CNBC, but they see the same data everyone else does. At $89, silver isn't expensive anymore. It's discounted. At $90, it's still discounted. And when professionals smell a discount in a market that's already moving, they don't wait politely. They chase. This is where the next 24 hours get dangerous for anyone betting on calm. Most funds are structurally underweight silver, and that's not an opinion, that's a fact. Silver has been ignored, sidelined, treated like a relic, while capital flooded into tech, crypto, and anything with an app attached to it. Now, those same funds are scrambling for exposure, and here's the problem. They can't get physical metal. There isn't enough available, and what exists carries premiums that make compliance departments uncomfortable. So they do the only thing they can. They buy paper. That paper buying pushes the price up. Higher prices create headlines. Headlines trigger retail fear of missing out. Retail panic keeps the mint closed longer. A closed mint tightens supply further, which pushes premiums even higher. And just like that, you've built a feedback loop that feeds on itself. This isn't linear anymore. This is super exponential behavior, the kind that looks calm until suddenly it doesn't. Gold is quietly confirming all of this in the background. Trading around $4,116, it's holding its breakout without drama. No fireworks, no hysteria. That stability matters. It tells you this isn't just a silver story, it's a currency story. But notice something important. Silver is outperforming gold. That doesn't happen by accident. Gold's move is monetary, silver's move is physical. Gold is being repriced because currencies are being questioned. Silver is being repriced because it's actually running out. Those are very different dynamics, and when they collide, silver almost always leads. The spread between Shanghai and New York is the cleanest signal you could ask for. You can't fake it. You can't algorithmically massage it. Physical metal doesn't care about narratives, speeches, or press releases. It's heavy, it's expensive to move, and it only flows one direction, toward the highest bidder. If buyers in China are paying $100 for an ounce of silver, then silver is worth $100. Full stop. Anything else printed on a screen is just a suggestion. The comics can show $89 all day long, but that only makes it wrong. And markets have a long history of punishing systems that lie. The punishment always looks the same. Inventory drains, delivery stress, and eventually default, either explicit or quietly rebranded as force majeure. And what we're seeing now is the consequence of decades of suppression. Imagine holding a beach ball underwater for 40 years. It works right up until it doesn't. When it finally escapes, it doesn't drift gently to the surface. It launches, and anyone standing above it gets hit square in the face. So now we reach the endgame discussion. What happens next? What does the path to triple digits actually look like from here? First, let's deal with the obvious question everyone asks. Is $90 the top? Is $100 the top? The short answer is no, but the reason why matters more than the number itself. $100 isn't just a price level, it's a psychological threshold. For generations, silver has been framed as cheap. The poor man's gold, something that trades in the teens, maybe the 20s if things get exciting. The idea of $100 silver lived in the same mental drawer as flying cars and cold fusion. That drawer just opened. And with physical trades already happening near $100, the impossible has become mundane. And when the COMEX price finally gaps up to meet that reality, which could happen shockingly fast, it will trigger a media frenzy that feeds demand instead of suppressing it. Silver hits $100 isn't just a headline, it's an alarm bell. Here's the paradox most people miss. When silver hits $100, the public won't think it's too expensive. They'll think it's about to hit $200. Rising prices, one to reduce demand, they'll validate it. That's classic Veblen good behavior. Price becomes proof of value, not a deterrent. The US Mint unintentionally supercharged this psychology. By suspending sales, they sent the clearest signal possible. Silver is hard to get. And humans have never reacted calmly to scarcity. When the mint eventually reopens, whether next week or next month, demand won, T be lower. It will be pent up, emotional, and price insensitive. So no, $100 isn't the ceiling. It's the starting gun. Now let's talk about the deeper reason silver is moving, because supply and demand alone don't tell the full story. This is also about the dollar. What we're witnessing is a real-time devaluation of the US dollar against tangible assets. Gold at $4,600 confirms it. The eastward flow of physical resources confirms it. Sovereign bond stress confirms it. When a government struggles to borrow cheaply and struggles to secure strategic materials, it's losing more than control of markets. It's losing sovereignty. The closure of the mint isn't an isolated embarrassment. It's a symptom of that loss. This is why the hardest part for many investors will be what comes next psychologically. The temptation to sell at $90 or $100 will be overwhelming. You'll look at the gains and feel smart. You'll want to lock them in. But lock them into what? Into a currency the mint itself can't reliably price? Into paper that other nations are openly rejecting? That's not profit-taking. That's asset conversion in the wrong direction. The strategy hasn't changed, but the urgency has. The exit is ounces to assets, not ounces to dollars. You hold silver until the mania flips the distortion the other way. until silver is overvalued relative to real things. Land, businesses, cash flowing real estate. That's when you trade. At $90, silver isn't expensive, it's catching up. Historically, at the 1980 peak, it took around 800 ounces of silver to buy the average US home. Today, even at current prices, it takes several thousand. The gap is still enormous. Then there's the gold to silver ratio. With gold near $4,600 and silver near $90, the ratio sits around 51 to 1. Geologically, it should be closer to 15 to 1. Even a partial normalization implies silver well north of $300. That X, not fantasy math, that's historical context. Until that ratio compresses meaningfully, until the mania reaches the point where people who have never bought an ounce are giving silver tips at dinner parties, the trend remains intact. The coming weeks will be messy. Banks may counterattack. Margins could be hiked. Rumors will circulate about plenty of supply and imminent normalization. Ignore the noise. Watch the data. Are ounces returning to JP Morgan? No. Are Shanghai prices falling? No. Are premiums collapsing? No. The fundamentals are locked in. The bridge behind us is burning. There's no path back to $20 silver. That world no longer exists. We're entering a new era defined by resource nationalism and physical scarcity. The U.S. government admitted there's a problem the moment it closed the sales window. It showed its hand. Now you have to decide how to play yours. If you already own silver, secure it. Not in a bank deposit box. Banks take holidays. Possession matters. Private, non-bank storage matters. If you don't own silver, the window is narrowing fast. Even at $90 or $100, physical metal beats paper promises that are quietly being abandoned. This is the signal many have been waiting for. The system didn't break loudly, it blinked. And that blink revealed everything. The mint is closed, the vaults are open, the price is vertical.